Todd Rosenbluth, Head of Research here at Vetify. Thanks for joining us for our latest webcast. This one's sponsored by Sprott Asset Management. We're here to talk about rethinking energy exposure. Now, the transition to cleaner energy is something that and I'm sure you hear a lot about throughout the media. It's especially true given the global legislation and a focus on 2050 for the net zero carbon emissions. These goals involve a shift towards electric vehicles, getting more of those on the road, but there's a lot of uncertainty about what this means for investors and advisors, how this can help them with their energy allocation. So I'm excited we're going to dive into this topic on a couple of different levels with the team at Sprott. So a few things I want to go over with you before we dive into the overall presentation. We are going to ask lots of questions of my fellow panelists, but you might have some questions of your own that you want us to cover. Please submit those using the Q&A box in the bottom right corner of the screen. We'll get to as many of those questions as we can. Now, if you're looking to bone up on the material on this topic, the team from Sprott has put together a great resources in the folder widget. There's white papers, there's fact sheets, there's information specifically on the gold, silver, and critical minerals channel. Mineral channel is harder to say. That's available on the ETF Trends website. Lots of great insight for you. And I know you're going to learn a lot throughout this presentation because, as you'll see on the next slide here, I'm joined by Steve Schofstall, who's part of the Sprott Asset Management product management team. He's been with the company for a while, but previously was part of the ProShares team, focusing on their dividend growth suite and tied to and focus on product launch initiatives as well. So, Steve, I'm really excited to have you join us. Thanks a lot.
Great to be here, Todd. Thank you. And as you mentioned at the onset here, the energy transition is really something that is really making itself known in the media. And kind of the way we look at that is, it's not really anything that's new. So if you go back throughout history, we've been transitioning our energy sources. If you go, 150, 200 years ago, we were mostly burning wood and coal to generate our energy. And by the time we get up into the 1950s, we start to see natural gas, at least in the United States, produce about 17% of our electricity. And by the time we move into the 60s, we really start to see oil move front and center on a global scale. And that's when nuclear energy really started to get commercialized. So this transition is just the next phase that we're entering into. As we'll go throughout this deck here, what you'll see is there's several opportunities that are emerging with a focus on cleaner energy. And that can mean a lot of different things to different people. And we'll get into that as we go. But from our standpoint, there's a few things that we see happening as we do transition to those net zero global commitments that we're seeing from 97 different countries now, where they're targeting net zero emissions, some as early as 2050, which seems to be the standard benchmark. And what that transition means is it doesn't mean, at least in our opinion, we don't expect to go completely away from fossil fuels. We could, particularly as we move through the next, decade and a half or so, we could see actually a growth in our usage of fossil fuels. We do think that longer term, looking several decades out, that there is a place for those fossil fuels, particularly natural gas, in our energy supply chain. And one of the things that we think we may start to hear more about, and we're actually seeing it across the energy transition industry, and when we look at what governments are doing, is a renewed interest in nuclear power. And we'll talk a little bit about that as we go and what leads us to believe that we're at a new renaissance there with nuclear power and how it's being embraced now on a more global scale than, say, 5 or 10 years ago. And then finally, as it relates to the global transition, we see on the battery storage side, and particularly EVs, we expect to see significant demand coming for a number of critical minerals from those. So the battery storage obviously are the batteries in the electric vehicles, but also do back up renewable energy sources like solar, wind, and hydro. So with that, I think we can move to the next slide and discuss some of the investment that we're starting to see in the energy transition. So if we look back at 2022, that was really a banner year for global investment in the energy transition. If we look at some Bloomberg research and other research that's been out about last year, we see that about $1.1 trillion on a global scale was invested in the energy transition. And that's significant for two reasons. One, it's the first time that we breached that $1 trillion investment mark. And then secondly, it also put investment in line with what we were seeing for fossil fuels. So two pretty significant milestones last year. And within that, we saw about almost $500 billion on a global scale dedicated to electrified transportation. So that would be everything from EVs to building out charging infrastructure to light commercial electric vehicle applications and things that follow suit there. Some of the estimates show that, like if we look at the International Energy Agency, they could expect up to 350 million electric vehicles on the road globally by the start of 2030. And that's really one of the key drivers behind the energy transition here, and would represent about a 45% annual increase as we go through the decade. So we do have this large scale investment that we're seeing on a global basis, but we're also seeing a trend where particularly Western nations brought on by COVID-19 pandemic and also the war in Ukraine are looking to reshore some of their energy sources. And that can be sources that we haven't traditionally had large industries for, like battery metals, the mining and manufacturing of batteries. And then also in uranium, we're seeing that come on. So when you look at this slide here that we have about $400 billion is the official estimate of clean energy funding from the Inflation Reduction Act, which is the largest clean energy act passed here in the United States. Some estimates, independent estimates, say that number could actually grow closer to $1 trillion by the end of this decade. So a lot of money floating around, not just in the United States. And I think we're at a different point where a lot of this investment has been happening overseas, and it's just now starting to make its way here. So moving forward to the next slide, what does that mean from a practical perspective? So if we look at since the Inflation Reduction Act was passed, you can see the number of projects here in the US has really exploded. There's about $80 billion of private investment that has actually occurred. And if you look at that, those large red circles, those represent battery manufacturing. We have a battery belt emerging from Michigan the whole way down to Georgia. And so we have kind of several factors that are coming into play. We have federal money coming in and supporting these industries. We have battery makers, particularly in South Korea and Japan, investing money here so that they can take advantage of tax incentives either now or into the future. And then we also have state governments that are trying to win business and bring these new industries to their local economies. So they're also providing tax incentives. And you're seeing that a lot in the South and then also in the Northern Midwest. Moving to the next slide. So when we talk about the energy transition, we tend to think of it in three different phases. We have the energy generation, and within that bucket, we have things like uranium, silver, and rare earth metals. I think uranium is pretty self-explanatory for its use in nuclear power. A lot of people aren't familiar with the usage of silver in the energy transition. Actually, about 10% of all silver that's mined is actually used in the energy transition, particularly around solar panels. And then rare earth elements are used, given their permanent magnet properties, are used in wind turbines and also electric vehicles. And then on the battery storage side, we have lithium, nickel, cobalt, graphite, and manganese, all of which play important roles in battery storage. Tying these two pieces together is copper. Copper is one of those elements that really conducts electricity very well. It's light, highly recyclable, and can be used in many applications. Pretty much anything that has electricity that passes through it will have some amount of copper in there. And so we kind of tie that together with those elements. So moving to the next slide, we can talk a little bit about how they're used within the energy transition. I mentioned uranium. I think we're good there with the nuclear standpoint. What I want to do is focus on copper just for a second. Copper is one of those things, as I mentioned on the previous slide, it really does filter across the entire energy transition. So if you think anytime we put up a solar farm or a wind farm, all of that electricity has to reach the grid. That's all being done by copper. If we have, as we increase our usage of EVs, we start to see the need to build out this electrified charging stations and infrastructure. Again, that's all going to be run by copper. And then also in the production and building of EVs, you see a significant amount of copper. If you look at a normal gas-powered car, you're going to see about 48 pounds of copper that's in that car. For an electric vehicle, that actually jumps up closer to 180 to 190 pounds of copper. So significant resource demand on the EV side. And, we did talk about all the other minerals that we saw and listed the 5 battery metals that we look at. There are different battery chemistries that can impact, to what degree they're used in EVs, but the electric vehicles are really driving this transition, along with the generation that the electric power generation. And they kind of go hand in hand, right? So as we increase our electricity demand for need for charging EVs, we have to build additional generation capacity. Next slide, please.
Yeah, Steve, I think this next slide is going to talk about just the growth we've seen in the electric vehicle space and what it means for critical minerals.
That's correct. So there used to be the old adage, and I've seen, political cartoons or whatever in the, last 5-6 years, it would show somebody plugging in their EV, and on the back of the outlet is a coal-fired power plant. And this notion of, okay, well, the EVs are clean, but the energy that they're using to power those EVs isn't very clean. What this is depicting is that as you start going throughout the first half of this decade here, we're seeing an increasing amount of our electricity actually comes from clean energy sources. Currently, that's about 40% on a global scale. Once we get to about 2050, the expectation is that we'll be above 75, nearing 80%. And with that, we're starting to see EVs really ramp up in the second half of this decade. And we'll talk about in a few slides here what that means for lithium. But as the EVs are increasing in adoption, we're seeing the power to power those EVs is increasingly coming from clean energy sources. And just to give you an idea, last year we had about 16.5 million EVs on the road globally. This year we're closer to the 25 or 26 million EVs. So pretty significant jump, about 60% just in the last year. And as I said earlier, we might potentially see about 45% increase throughout the remainder of the decade. Next slide, please.
I think Steve froze for a second. Pause for a moment, Steve, if you can, to refresh. And I'm going to move us one slide forward, which is going to talk about the lithium supply deficits and what that's going to mean for battery demand.
There we go.
It's likely to increase.
Are you able to hear me?
Be driven by batteries, which are expected to account for 95% of the lithium demand for 2030.
Am I back, Todd? Are you able to hear me okay? Okay, things are quiet on my side. I'll keep moving here. Apologies for that. Not sure what happened. So I want to talk a little bit about the lithium demand. What we're seeing, and it's kind of evident as if you track that yellow line, that's what we're seeing from a lithium supply perspective. So what we expect to see to about the middle part of this decade is we're expecting to see a small surplus in lithium as we move through 2025 or 2026 or so. As we start to see greater adoption in EVs, we do expect to see not quite a hockey stick, increase in the amount of lithium demanded, but it's a very significant increase in lithium. There's a number of things that are going to play a factor into meeting that demand. One will be increasing the amount of mines that are producing. So right now we have a significant permitting process in most mining jurisdictions around the globe, in which it can take 10 to 15 years or perhaps even longer to get a mine from discovery to operational, where it's really starting to contribute meaningfully to the lithium supply. So there's a lot of work, I think, that needs to be done in expanding the mines. What we're seeing on the miner side is we're seeing starting to see more mergers and talks of acquisitions as those miners are looking to procure those mines that are already either operational or near operational. And we're seeing also at the same time automakers, as they're expanding their EV aspirations, particularly as it relates to those either selling vehicles within California, which is basically everyone, or producing within Europe. A lot of mandates are starting to pile up, basically requiring these automakers to phase out their internal combustion engines for new vehicles by 2035. Some automakers are being a little more aggressive on their own accord and looking at a 2030 date or even a 2040 date on the less aggressive side. But we are expecting to see, as we move into the next decade, a pretty significant increase in the amount of lithium demanded. And we have to look for new ways to kind of move shift that supply and demand paradigm. And we're starting to see some new emerging technologies, which we won't delve into here, where we're able to extract lithium from sources that necessarily weren't an option before, and in some cases alongside oil and gas wells. With that, I think we can move to the next slide. So I mentioned nuclear up front. One of the things that really sticks out about our view on the energy transition relative to maybe some other asset managers is we think that nuclear energy is going to play a very prominent role as we move through the transition. And we're starting to see significant evidence to support this. So if you look back, the last time that we've had a pretty significant momentum in the uranium market was back around 2011, and that was around the Fukushima incident in Japan. And at that point, we had a lot of countries start making plans to phase out their nuclear power plants, including Japan and South Korea and some countries in Europe. And what we've seen now within the last year, 6 months, or even a few years, is some of those same countries, like Japan, like South Korea, are extending the life of their existing nuclear power plants. And they're also making plans in some cases to actually add to the nuclear power plants. Japan's actually bringing on a number of plants that have been offline since they turned them off in 2011. And we expect that to continue to contribute to the increase in nuclear power on a global scale. What I wanted to include in this presentation was just briefly, just a quick view on a global scale. What does nuclear energy look like and the growth look like as we move through the transition? So currently there's about 435 reactors that are currently online. And I think a lot of people are surprised to know that about 100 of those are in the United States. And prior to a new reactor coming online in Georgia a couple, 5-6 months ago, we really haven't built new reactors for a few decades. So you're starting to see this push internally in the US to embrace nuclear energy. We expect to see another nuclear power plant in Georgia, another reactor come online either in the first or second quarter next year. And we're starting to see bipartisan support and investment and commitments from our government to actually incentivize nuclear energy. And one of the driving factors behind that is Russia, who is a very large player in the uranium enrichment process, is, with their ongoing war in Ukraine, it's something that we're trying to pull that away from the Russian economy so that we can develop our own fuel sources here as it relates to nuclear. And there's a number of bills, about a dozen or so, at various stages going throughout Congress that are contemplating what's the best way to do that, incentivize local production or friendly production, whether it be in Canada or European production of not only physical uranium, but also the enriched uranium. So next slide, please. So this is just a view at where we see the current supply and demand dynamics with physical uranium. So going back to 2011 or so, and even before that, a lot of the uranium that was being consumed by nuclear power plants really was coming from this buildup of stockpile that happened during the Cold War. So we were really running off, for the better part of 2 decades of this stockpiled uranium, and there wasn't really a need to add significant mining capacity. Well, when you fast forward to where we're at today, we start to see that uranium production capacity is looking to peak here in the next couple years, and we see this growing supply and demand gap, similar to what we're seeing with many of the other critical minerals. So there's going to be a lot of work that needs to be done to get these mines up and running. It's not an easy task. If you go back, to 2010, 2011, the incentive price for which uranium miners could actually mine uranium profitably was about $50. Today, that number is closer to $75 or $80 a pound per uranium. So to give you some context, since June, we've had a really big run up in the price of uranium. We're sitting at about $70 a pound. So we're not quite at those incentive prices yet for more mines to make sense to start bringing more capacity on. And then finally, next slide. So we want to lose some time. Go ahead.
Steve, I just wanted to jump on in. I'm back here. I'm on the phone. My apologies for it, but I'll be joining you for Q&A as we talk through the ETFs that are showing up on the screen.
Great. So I just did want to take just a moment before we get into the Q&A just to focus on the energy transition options and ways that investors can take advantage of this potential opportunity. So one is our physical uranium trust. This is a fund that we put to market about a little over 2 years ago. It actually stores physical uranium. It's a closed-end fund. It's listed in Canada and then also trades OTC in the United States under ticker SRUUF. It's about a $4.5 billion fund that just stores physical uranium, much like you might see with other gold ETFs where they store physical gold. This just houses uranium. And then we wanted to provide a number of ways for investors to really express their view in the energy transition. And one of the things I like to tell investors that we hear from is, the energy transition can be somewhat polarizing, right? Some people are in favor of it, some don't see the merits behind it. But at the end of the day, with the amount of money that we're seeing flow into the sector and the emerging companies that we're seeing, it's really undeniable that there is this emerging investment opportunity there. And so for those that want to potentially take advantage of that investment opportunity, we wanted to provide a few different solutions. SETM, which is our broader based fund, it's the Sprott Energy Transition Materials ETF, that actually invests in those 9 critical miners and producers of those 9 critical minerals that I mentioned earlier on that flywheel, covering the generation, storage, and transmission of cleaner energy. And these are all pure play strategies in that we're focusing upstream on the supply chain. So we don't have to worry about which battery chemistry is going to be the predominant chemistry used by different auto manufacturers, or if there's new technologies coming out. At the end of the day, all of those technologies will harness the materials that these miners are bringing to market. And so we wanted to focus on that upstream application and make sure that we're focusing on companies in SETM's case where at least 50% of their revenue is coming from mining those critical minerals or producing those critical minerals. And just by way of index methodology, we actually go through a very rigorous process where we look at each individual company in the index, quantify how much of their revenues are coming from the different critical minerals, and then we assign an intensity score. So for example, if 80% of their revenues come from mining battery metals that are included in the index, approximately 80% of their float adjusted market cap will be included in the overall index calculation and weighting scheme. And then for those that want to get a little bit more targeted exposure, we have LITP, which is the only pure play lithium miners ETF out there, which just focuses on lithium miners. URNM and URNJ are complements to our physical uranium trust. URNM is an all-cap physical miners ETF, or uranium miners ETF. For somebody that may want some physical exposure to the miners or to the uranium, you'll get about 15 to 17% physical uranium exposure within URNM. URNJ is a fund that we launched back in February. It's listed on the NASDAQ, focused on those smaller producing or exploratory uranium mining companies. Actually had some really good success. That fund's already grown to about $150 million in assets. It has been one of the top performing funds for the last several months as we've seen this uptick in uranium. It's done a nice job of capturing the move of the physical uranium market, but with the tilt of equities. And then finally, on the copper side, we have our junior copper miners ETF focused on the smaller copper miners, and then the only nickel miners ETF out there. So not only are all these strategies pure play, no other funds exist catering to junior uranium, junior copper, or nickel miners. With that, Todd, I can hand it over to you for the Q&A.
Yeah, That'd be great. And we're going to put the poll question up for the audience. Do you plan on adding to or initiating a position in any of those Sprott ETFs that Steve touched on in the next 6 months? A simple yes or no would be great. While we keep that up, I want to combine a few different questions that came in together. Green energy is a changing market. Do the funds provide exposure to emerging energy technology? And what if technology changes and we need less lithium? I know it's a combo.
Sure. So, and going back to what I talked about, our strategy around these funds, we are focusing upstream. So those that are bringing the minerals out of the ground or bringing those minerals to market. So from that standpoint, if there are new emerging green technologies and to the extent that they're using the same minerals, we would expect these funds to play a role in that, because at the end of the day, they are supplying the minerals. One of the questions we get asked a lot about, and it relates to your second part of the question around new technology, is, well, what about solid state batteries within EVs? And in actuality, those solid state batteries, which many people point to as kind of the next iteration, we're probably a decade to a decade and a half out from those being commercially viable, but they actually use a significant amount more lithium than what our traditional lithium-ion batteries are using in today's EVs. So to any extent, we would expect to see, in most cases, a lot of the same minerals being used in these ETFs and the miners that are held within these funds supplying those minerals. We would expect that to be well positioned to potentially take advantage of any changes in technology.
Thanks. And we might do one final question here. I'm in New York City. I don't see a lot of charging stations. I know electric vehicles require infrastructure. Is the lack of charging stations going to hamper EV adoption?
So that's a great question, one we hear a lot. You don't see a lot of public charging stations. There are a number of private charging stations that are available. One of the things that is really needed for that is to increase our infrastructure, and that's going to mean a lot of copper. Not only does that mean copper for bringing out the transmission lines and allowing the EVs to be charged, but we also have to have reliable and renewable energy sources if we're going to stay within that 2050 framework for net zero greenhouse gases. That's one of the reasons we think nuclear energy has a very big role to play in the energy transition. Solar is great when the sun's shining, and it can produce energy for parts of the day in different parts of the world where there's plenty of sunshine. Wind turbines are useful for areas that have significant winds that blow through and can power those. But nuclear energy actually is a clean and safe alternative that provides that baseload energy that's always on. You can dial it up, you can dial it back to meet the energy needs. So what we're thinking is, as we see more countries start to come to the realization that nuclear power is going to be a major part of the energy transition, we're going to see that power the EV infrastructure that we need. So it might take some time to get there, maybe a little longer than what some projections are taking. But as long as governments and private companies are investing in that and committed to moving that direction, we expect that we'll get there.
Well, thanks for that. I know you love all of your Sprott ETF children equally, which is why we didn't ask the question of which ones people are going to buy, but just a broader subset of it. But exciting to see the broad lineup that Sprott offers. I know we didn't get to all of the audience questions. My apologies for that. But somebody from the Sprott team will certainly follow up with you if we haven't gotten to your question. Really appreciate you sharing your expertise with me. Appreciate the flexibility, and thanks. And we'll be tuning in next time. So thanks everybody for your time today.
Thanks for having me.